Well,
I just want to recording in progress. We'll start with that. So we are recording this event. First and foremost, I just want to thank Mark Castancino with MJ Home Lenders. We've really been trying to do a series of events over the last few months and the months to follow. By bringing in guest speakers, thank you for the lunch as always, Mark. You always bring a really nice array of food items.
Yep.
But I'm going to turn the floor over to you. But again, thank you for really bringing this to our agents.
You got it.
Thank you, Mark.
All right, so hi guys, how are you? I'm Mark Castancino with NJ Lenders, and this is Vic Melillo with credit. What company do I see it with now? Because I can just
The 30-year credit max.
yeah. So Vic and I have been working together for 30 years in the credit industry. Vic has been a mentor to me with credit when we start trying to help your clients build credit and help their credit scores, help them get mortgages, go along those lines. So we're going to talk a little bit today about the credit myths, so to speak, things that we hear about out there that you guys may have some questions with. So we will turn it over at some point to a question and answer. I think Vic and I will talk a little bit about credit with you guys, and we'll answer maybe some of your questions you have already. But if you do have a question while we're going on, put your hands up. I'll call on you and we'll go from there. Maybe we're 15 minutes, maybe we're 45 minutes. I guess it'll depend on how long, what kind of questions you guys have. So I know the biggest question that I get asked a lot by the agents are, my client's pre-approved already. Their credit's been ran by XYZ Bank, but I want them to speak to you to get pre-approved, but they don't want to have their credit rated. What effect does it have on their credit score? Does it even matter?
Correct, and that's probably the biggest misinformation out there. People thinking that an inquiry is going to ruin their credit score and have this fear. They don't want that extra credit pull. If an inquiry impacts a score, it's 2 to 5 points. And in most cases, the inquiry is not impacting that score, but people believe sometimes that an inquiry has impacted their score because credit changes. So depending on the time frame of when the first credit profile was pulled, and a second lender may be pulling it to review, if there's changes on the credit, the score is impacted, but it is not to be blamed on the inquiry, because again, if an inquiry impacts a score, 2 to 5 points.
Yeah, so a lot, like what he's basically saying to you guys, it really doesn't matter. I know years ago we talked about something called a shopping clause, but within the same industry.
Correct.
So if they are ran by another company and it's a mortgage company, it's ran again by NJ Lenders, it's the same industry, it's a mortgage inquiry, so it really doesn't have a negative effect on the score at all. So another big question I get is I get on the phone with a client, how's your credit? They'll say my credit score is 740. So I'm like, great credit score. My next question is, where did you get that score from? And a lot of times they'll use Credit Karma. And they'll say, I got Credit Karma, I went online, I had Credit Karma at 740. I run their credit report and their scores is 680. Can you kind of educate everybody a little bit on that?
Yeah, so let's be clear, FICO has many versions of their scoring models.
What's FICO again?
FICO is Fair and Isaiah companies, 2 real people, and Mr. Fair and Mr. Isaiah are the geniuses who formulated the methodologies to look at your credit profile, pull some scorecards out, and pop up a score ranging from the mid 300s to the mid 800s. So as a consumer is out there accessing their credit, which today, the internet, they have multiple areas that they can access their credit profiles from. You kind of need to know what that scoring model is. So Credit Karma, classic example, is using TransUnion, and a lot of times it's providing either a different model of the FICO score, or it can even be providing the Vantage score, which is a challenger to Fair and Isaiah, trying to say, hey, they're making a lot of money. I think people will respect our score. And the Vantage score model ranges from the mid 400s to the mid 900s. Why they changed it, I don't know. It's kind of like why we have a Phillips head and a flathead screwdriver. We don't know. We just have to accept it. But again, when that consumer is getting their credit, you need to ask, where did they get it from? And if it's not from another lender, then they have to understand the importance of having a lender pull their credit so they know their true FICO mortgage scores, because the models the lending industry is deemed to utilize are versions 4 and 5, which are literally from like 2005.
Yeah.
So that's how old those models are. FICO is up to version like 12 now or higher. And if you have a real discerning borrower, tell them to go to myfico.com. They can pay for their credit report. And the only reason I suggest that is because they can see every score model. So they will see their score, the 740, where they may have gotten it from, and then it'll tell them, here's your true lender score, so that they know the honesty of Mark and what he's sharing with you, and it's not any sales tactic to say, well, you're really not a 740. It's not the car dealer trying to make you pay more.
Yeah, because like our goal, guys, is to increase your business, you guys closing more loans. So if you're in a car with somebody, or if you're at a house and or you're on the phone with them and they tell you what their credit score is, you want to ask, hey, where did you get that score from? And that may be your opening to say, have you been pre-approved before? You know what I mean? And then go from there. But try to learn where that score came from, because like Vic said, the Credit Karmas of the world, which is a great organization, they use a different scoring model than what our industry uses. So it could be your client thinks they're going to get a rate that's the best rate out there in the industry, and when they talk to me, I'm telling them a rate that's 0.5% higher because their credit score is 80 points lower than what they thought it was. So we're talking about credit scores, and so how does so for instance, how do we help somebody build credit repair companies? We get involved we can guide them on best practices in helping have a higher credit score.
Correct. I always like to say that credit's renewable, not repairable. All right, and we know all the advertisements out there, the radio, the billboards, everything, talking to people about trying to repair their credit and helping them improve their credit. So there's truth behind the actions that you need to take to help build better credit. And it starts with simply, do they have active credit?
Mhm.
If you don't have any active credit, nothing reporting positive for 6 months, your FICO score is a 0. Risk score not calculated due to lack of recent credit activity. Credit scores don't know how much money you make or how much you have in the bank. They just know who and how you're paying people. So you want to have these conversations. We want to help you increase your verbal repertoire with people that says, hey, I really need to speak with you, or I really want to speak with you. You're giving me information that no one else has shared with me or told me. And that's where we like to come in for you, so that again, you have this additional conversation with them and you're saving your time. We don't want you out there driving and showing and doing and spending and then realizing that this person cannot qualify.
So Vic said some people have no credit score. That's not a total negative, but it's not the greatest thing. Can somebody get a mortgage with no credit score? They could, but a lot of times they have to be coupled with somebody that has a credit score. So if you have a husband and wife, for instance, and the husband has a 750 credit score and the wife has a 0 credit score, they can still potentially get a mortgage. But there's some rules we have to follow after we run it through the automated underwriting system that might say the borrower that makes more money might be the person without a credit score. We have to do what's called non-traditional verifications. Non-traditional might be your car insurance payments, your rent payments, your cell phone bill payments. So there are options for people when they don't have credit, but we want to help them build credit. So Vic, I've heard when we talk about building credit, go get a secured credit card.
Correct.
Go to a department store and open up a credit card. So if I was to go to one of the banks that offers a secured credit card, how does that work? And how long does it take before that secured credit score starts showing up on one's credit report?
Perfect. And as he's speaking about building credit, I want to clear one idea that's out there. People are thinking about authorized users. Let me piggyback on someone else's credit card, okay? You need, or your customer needs to have their own credit, okay? Because if you're an authorized user on someone's card, you're trusting them to pay that account. You have no control on that account. They could hurt you down the road more than they could help you. But individually.
Hold your thought there real quick.
Yep.
Authorized user, just what that means is if we think about, if some of us here have children and you get a credit card when you go to college, you add them to the card. So they're an authorized user, but they're not contractually responsible to make those payments. So that's what Vic's talking about, adding somebody as an authorized user. It's not always a positive. And I've seen situations where the child, the child's on the parent's credit card and they put them on an Amex, and the Amex has a $30,000 credit limit, and they owe $30,000 on the credit card. That's actually a negative to the kid's credit score. So we ask them at certain points, can you get your name removed off that credit report, because it actually is having a negative impact on their score. So I just wanted to explain quickly what authorized credit means.
Correct. So that person that doesn't have credit needs credit, they're applying for credit, and everybody's saying no. So as Mark alluded to, there is secured credit cards. There's popular companies, I don't get anything for it, but I just mentioned them, Capital One and others. You can go online, and basically if they're saying, we are not going to approve you for an unsecured credit card. We will approve you for a secured credit card, which means you may have to put up $200 or $300 or $500 to now have a $200 or $500 credit limit credit card sent to you. Understand and tell your individuals that secured credit card needs to be managed like a regular secured credit card, because some people will think, well, I gave them $300.
Make a payment.
You know, I'm not gonna make the payment this month, I'll just take it out of the 300, and then when I pay it back, it goes back into that account. It doesn't work that way. They will report you late, you will have a negative, and you've just been counterproductive for yourself and your score. And a lot of them down the road will change it from an unsecured card to a secured card over 12 months of good payments for yourself. And there's strength in numbers. So some people say, Vic, I'm gonna go and get a $3,000 secured credit card. And I said, no, I'd rather you go out and get 3 $1,000 secured credit cards. Because credit is like two people saying something good about Mark and I. You might be like, well, maybe they know them, maybe they're paying them to say good things about them. But if 10 people say good things about Mark and I, you're gonna say, they gotta be right. And that's the same way credit works, is that strength in numbers, having multiple active accounts. So again, there's multiple people saying good things about you, and that's where the stronger credit scores come from. I'm not looking to put people into debt, but you need to have 3 to 4 active revolving credit card accounts, minimal balances, but you need that activity so there's multiple good things being shown about you to generate a nice high credit score.
All right, so I have a question regarding that. So I open up that credit card with $1,000 credit limit, and every month I charge $1,000 and I pay it.
Right.
Is that a negative or a positive? So I have a $1,000 credit limit and I charge $1,000, and then I pay the $1,000 when the bill comes. But the following month I charge $1,000 again, and I repeat the process. Is that good or bad?
So I'm gonna say that that is bad. And here's the bad side about that. What gets reported to the credit bureaus when a statement is generated? So if he's charging and maxing that credit card each month up to $1,000, and then the statement gets generated and it's $999, that's what gets reported to the bureaus. It looks like it's a maxed out credit card. And when you have maxed out credit card, bureaus view that as a risk. What if he doesn't have the ability to pay that next month? What's gonna happen? So you wanna keep those balances typically at around 50% or less of the credit limits. And you do need a balance to report. We were just speaking about it with a couple of younger millennials, and they today, right, everybody's online and most of that stuff. So it's, I go, I charge, I come home, it's bothering me that there's a balance on that card. I log in right away and I pay it. So every month the statement is getting generated with a 0 balance. So believe it or not, 0 or maxed out, probably the same negative impact. A, 0 is not showing activity. B, $1,000 is showing too much activity. So you gotta find a balance within there, and ideally for scores, keep those balances around 50% or less of the credit limits.
Can we pay that though? Like, say your max is 10,000 and you spend 5,000 and just half,
Right.
but then when your statement came, you paid it full.
Correct.
Is that okay?
That's great.
Okay, good.
That's great.
But what are you gonna do next month?
Same thing.
It only shows the $5,000 balance every month, so it looks like you always owe $5,000.
Well, I mean, it's not the same thing, but like, I mean, like I just have a tendency of just whenever I check my credit card, when the time comes, I just pay the full. Like, I don't pay like, so should I start paying minimum?
No, you know, her question is basically, look, she has a $10,000 credit limit. She's charging about $5,000 every month. The statement gets generated, reporting a $4,500 to $5,500 balance, and she's paying it in full each month. Is that good? And I'm saying yes, that is very good, because she's keeping that balance. If she was charging $9,500, I would say that she's charging too much, because they're reporting that maxed out balance. You can charge up on a credit card, but I have to think, am I going for an auto loan? Am I going for a mortgage loan? I want to prepare. I'm going to bring my balances down as much as I financially am able to do so. But also for your consumers, when we're transferring information with each other, you know, you might go out and say, look, it's probably good for you if you could bring down your credit card balances. It's going to raise your score. But I would say, let someone like Mark pull that credit report and let him tell them what to do, because sometimes that money in the bank could be much more important than juicing up that credit score 20 to 30 points. So again, there's a lot of insight, and we share a lot of information on the credit reports, but credit reports are kind of like a personality. We're all different. So certain things are going to be different for other individuals. There's not a lot that's written in stone.
So we talked about good debt versus, well, we touched on good debt versus bad debt.
Right.
So an example of bad debt might be,
So examples of bad debt could be, if you're getting approached by your doctor's office that there's a bill that's outstanding and, look, it may be going to collections and you're ignoring it because you're saying, I have the best insurance, or this isn't me, or I was in a car accident, my attorney's telling me, don't pay it then, don't worry about it, you'll be okay. Wrong. I always say, cave and pay and seek restitution later, because your credit is that important for you, from mortgages to job opportunities around for yourself. Some ideals of bad credit could be, a lot of people think they have multiple credit card accounts because they're carrying multiple debit card accounts. Debit cards with the MasterCard logo on it, the Visa logo on it. Yes, you can take it, swipe it, scan it, whatever you want to do. It's a plastic check. There is nothing getting reported to the bureaus about great payments because you're using two different debit cards as a Visa or MasterCard for yourself. So again, you need active, I like bank issued revolving credit cards as being number one, counting towards your score.
so now somebody ignores that doctor bill and it shows up on the credit report as a collection account. Negative impact on the credit, approximately how much in the first report?
Right, and you might think $30 collection account or $3,000 collection account, well, there's gotta be a difference if it's bigger, it's worse. No. We've seen $30 collection accounts impact scores over 100 points. So imagine that, someone is not an A paper borrower or buyer for you because they have this little medical test that slipped through Quest Diagnostics and you didn't know it and didn't pay it, and here it is. Now, I'm from the school of thought of, it doesn't hurt to ask. So tell these individuals to go and tell their story to the collector. I didn't know, it was a change of address, something like that. A lot of those medical debts, companies will retract or recall that debt. Sometimes you're still under the care of that doctor. He didn't know his billing office is coming after Mark for $100 bill. He's like, are you kidding me? Mark's here all year long, spending thousands of dollars. We're not gonna penalize him. That shouldn't have gone to collections, and we will recall that back to, again, preserve your credit. But it's paying attention and opening your mailbox, email box, or text message.
Exactly, it's not to, you don't want to ignore it. I've seen customers where they have never missed a payment in their life, and a collection account showed up because they moved and the utility bill didn't follow them, and they had an open account and then it went to collections. 3 months later, their score was, say, 760, and now it's 660, just because of a $75 collection account, and they were perfect on everything else. So if your clients are talking to you, like Vic said, pay it, and then fight for your money back later, because the effects on your credit are severe. So and then good debt is being in a situation, guys, where if you have a $10,000 credit limit, your client's gonna say, what should I do? And like Vic said, the first thing I do when I talk to a client is, before you pay anything down, let's talk about your total situation. What are you trying to do? How much money do you have? What do you have to work with? Because then what we do is we run what's called a simulator. I'm using the right term, right? Because I want to make sure.
100%.
Yeah, so we use what's called a credit simulator. So I call Vic up or his company up and we run it through, it runs a scenario for all the bureaus. And I'll say to Vic, he'll say to me, how much money do they have to work with? And I'll say, well, they have about $2,500 to work with. So he takes it, he puts it in the system, and he takes the $2,500 and it's gonna show us exactly what to do to improve their credit scores with that $2,500. And then we share it with the customer, they pay down the debts accordingly, and then we follow certain rules that we have to follow. If they're gonna print it off the computer, if they wait, or we just wait for time to go by, and then we do what's called a rapid rescore. So Vic will explain to you better with this, but the bottom line is, if you have a client that doesn't have the best credit when I pre-approve them, it doesn't mean I can't get their score of 100 points in 5 days, because I legitimately can and I have done it. Vic will explain to you a little deeper on how we go about doing it, but we do it every day. We're improving scores. Even when I have a client apply for a mortgage and their scores are lower. I have a client right now, they applied for a loan, the rate was 3.7 because the husband's credit score was in the 630s, the wife was in the 750s. I needed both incomes to qualify. So they're getting 3.7 right now. He already paid down all his debt to get a score from 637 to above 720. That'll be in 10 days or less, his score will be above 720, just by paying down his debt. We did the simulator And his rate's gonna go from 3.7 to 3.124, just as a result of that within 10 days. Kind of explain how it works.
Yeah, so in relation to this exactly, how many of us have received a phone call, I'd like to buy this home or a home or look for some homes, but I need help with my credit? Does anybody get that from anyone from time to time, right? So what is the answer that we could give them? You know, some people are still out there saying, well, maybe you want to look into credit repair, or people will call you and say, I need to repair my credit. But again, repair tactics take several months, if not up to a year. They're trying to write letters and dispute accounts on there, you know, write and pray it goes away is what I like to tease about and call it, versus, as Mark is saying, we have the scientific science via a what if simulator and a credit wayfinder to actually play with this credit report and give them the specific actions and timeframes to achieve their score goals. You could spend up to X to bring that score over 720. You could spend up to Y to bring it just marginal to get 640, 660, what you want in there. But your reputation is on the line. When someone, if you're referring someone to try and assist them to get their credit up, to help them to become that solid buyer for you, you need someone with a reputation on the line also, that's not selling them, that's not looking for money from the borrower in any capacity other than, hey, we're gonna look at that credit, we're gonna tell you specifically what to do, and if you are willing to do that, this can happen in 3 to 5 days, 3 to 5 weeks, or 3 to 5 months, because there are cases we're gonna make people unhappy before we make them happy. And they can walk away pouting, but you know they're walking away. What are they gonna do? They're gonna tell their friends, so-and-so from Keller Williams put me in the right direction. I didn't like the answer, but guess what? I'm gonna be a homeowner in 6 months or 12 months. Or they skyrocketed and I thought I was not qualified this week, but guess what? I'm gonna be qualified next week. And I can move forward. I have that solid commitment, forget pre-approval, I have that commitment for that mortgage, I could buy that house.
Correct, because there's times I have to send people on a, I use the term, it's a marathon, it's not a sprint sometimes when we're repairing somebody's credit, it takes a little bit of time. They don't have $15,000 to pay everything off, but over a 12-month period, they're able to work towards getting there. So we set them on the goal. And then I always try to share with you guys, put them in your database, follow up with them, see how they're doing, make sure they're staying true to form. We can revisit the credit in 6 months, see where they're at, see how their progress is going. But that's where we can still, when you get those leads that may, oh, they can't buy a house today, let me move on to the next. They should go in your database and we follow up with them on a regular basis. Because when I do it, they go in my database and I mark my calendar, revisit credit with so-and-so. And then we send them an email or it's a phone call. How are you making out? Do you want to revisit it now? Where are you at with everything? How is it going? It's a 5-minute call, you know, and then maybe you put it back in touch and we do what we have to do.
And they don't spare any expense. I can tell you, I deal with a lot of lenders, okay, nationwide, and I could just vouch for Mark and his company on, there's no expense spared as far as, he never calls me up and says, hey, can we look at this, but could you only do one bureau? Because I really don't want to spend too much money on this. It's like, Vic, go to town, tell me what I need to do and be solid. And the reason I point that out is we just had a live example the other day of someone coming to us and saying, just simulate one bureau. Well, the one bureau was saying this borrower had to spend over $5,000 to get their score over a 680. And then my right-hand guy in the office, I call him a credit master junior, he just said, you know, I'm gonna look at Equifax also. Equifax for $297 achieved the same point gain. Because remember, all 3 bureaus don't have the same information. And all 3 scores are not pulling the same factor code. So when you look at a score, there's these 4 sentences that probably nobody reads, but they're telling you why this score did not score higher, okay? It's always a negative, never tells you why they're so good. It's just saying, well, here's reasons as to why it's not scored higher. But we look at those factors, but again, he's not gonna say, save me $10 and don't run that extra simulator, when we just saved that borrower over $4,000 of not having to run that expense.
There is a legit cost to us when we do it, but we always look at it as it's a service to you. Talking about credit scores too, when you talk to your client, when we talk to the client, we have to use the middle score. So if it's one borrower and they have 3 scores and one score is a 620, another score is a 710, another score is a 750, that goes to what Vic's saying, checking all three bureaus, because maybe that collection account is only being reported to TransUnion and they don't report to Equifax or Experian. So we use the middle of the three scores. Now, if there's two borrowers and say Vic's mid score is a 750 and my mid score is a 660, everything's based off of my 660. So I'll try to take the borrower out of the equation and give our client a better interest rate if I can, that has a lower credit score. But sometimes you need all the income. So you have to use both borrowers. And that's when we try to improve their score while we're doing the process. You know, to say, hey, you can do this, we can get your score up to 680. Maybe it saves you just an eighth in rate, or they're paying PMI and the PMI factor goes down a little bit. So the PMI is cheaper per month because we're able to get that score up as we were processing the loan. There's still proof for the mortgage with the lower score, but we're trying to save them money as we're going on.
If we could, at 1 second, everything that we're talking about is great, but you know what? All of this, let's bring it right back to the beginning. That first conversation with that potential buyer before, hey, I'm willing, I want a mortgage pre-approval or someone to look at it, but you getting accurate information from them to get an accurate credit report. We all like to service, and I, because I work with the lenders, so I kind of drill them on this, and hopefully they're coming down the line and drilling you on it. It's nice to ask people, hey, what's your name? And I say, oh, it's Vic Melillo. Well, you know what? How's it appear on your driver's license? Oh, well, that's Victor M. Melillo Jr., let's say. Oh, okay, you really should, use that. How do you apply for credit? When your statements come to you in the mail, what name is on there? What address is on there? Because it helps with the accuracy of that credit profile, because we don't want to pull credit with, say, Vic Melillo, and something might be missing or might be omitted. And then now we're going legal, and we look at the ID and find out there's a variation of the name, and we need to re-pull credit, which could change scores dramatically in certain cases. So, try and get that initial, I know we're all trying to service and be quick and we don't want to bother people, but it's kind of like, hey, people out your driver's license and read your name to me, because some people don't even know, what the name is on their driver's license.
And that's when you do the contracts. When we do a mortgage application, we're trying to match their legal name, and we're using the driver's license. And we've had situations where the middle initials on the driver's license, we have to update the credit report 40 days later with the correct middle initial, and the score went down. That's not a comfortable conversation sometimes.
Hyphenated names,
yeah.
There's a lot of differences.
So it's starting accurate from the beginning, and for us, it starts with the mortgage application matching up to the ID. And for you guys, it started with the purchase contract and having the legal name on there as it reads on the driver's license.
Mark, I've never even thought of this, what you just said, so like my team is listening, so that means everybody from now on ask for the driver's license and get that one right from the beginning.
Yeah, excellent.
It helps even when your attorney does a title search. They're going up the contract, they see that name on there. Because sometimes we're in situations where we run the credit, we don't have the full name, or we have maybe their abbreviated name, whatever they, like Vic said, Victor, Vic, middle initial, junior, not. And one of the bureaus won't give us the report because maybe there was fraud with a similar name. So they just err on the side of caution, no report's not available. And then our client's gonna get on the phone with the credit bureau and straighten it out with the credit bureau directly. And then we run it, we find out what it is. We're trying to figure out why are they not giving us a credit report. So we have nothing. It's just saying, and we need all three bureaus. If three bureaus are available, we need all three bureaus to do a mortgage.
And that leads in the need for all three bureaus today, credit freeze. Okay, there's this panic by the whole world today about everybody's identity being stolen, and laptops are lost and systems are compromised. You're only a true victim of identity theft if someone does have your driver's license, social security card, or number they're applying for credit. An illegal charge on a credit card, you're not a victim of fraud. It was just swiped by someone with a smart computer. But again, a lot of people today are freezing their credit report. So as before, where we would say, okay, give us your name, address, and social, tell us how it reads on your driver's license. Is this address where your bills go to? Great, we're covered. The other topic is, have you frozen any of your credit bureau files? Oh, yeah, I have. Well, could you release that freeze? Because we get it all the time. It's just that extra step of the credit's pulled, it's missing one or two. They have to recontact the company to unfreeze the credit profile. Sometimes they only do it for 24 hours. So they call after work at 8 o'clock at night. Mark calls me the next day and says, hey, they just told me they unfroze it. I pull it again. And he says, I have to tell him it's still frozen. So, please, if they're gonna do that, let's get a permanent unfreeze. And again, the only ones that really need to freeze their reports is somebody's applying for car loans and other topics.
Mark, what determines the, excuse me, what determines the legal name? Now, you have one person that has a passport with one name, but in Europe, they have two last names.
Yep.
They have many countries. Then you have the driver's license that has one name, the social security card maybe has another name, and then they got married, they got a fourth name.
Correct.
So how do you determine which is the legal?
We
We
name?
saw that, the type of file that turns my hair gray.
Yeah.
That's a different subject. on a different tip. Go ahead.
So we usually work off the driver's license. So, yeah, we usually work off the driver's license, and if there's discrepancies, we match it up to the other documents that you mentioned, because you get a lot of times, you have a young couple gets married, and one of the spouses didn't change their name. So what name do you put on the application? Sometimes they get married during the transaction, did they legally change their name? So we ask those questions, and we try to go off the driver's license. So,
Yeah, because DMV is right, you're going, there were 5 different proofs of ID, so DMV is putting it together and saying, this is who you are.
Yeah.
So hopefully they remember to follow it.
So we kind of did our little show, so to speak, right? Any questions for everybody? Do you have anything, first, Vic, do you have anything else to add that maybe I didn't ask you that maybe?
I do earlier when Mark was saying about how I was his mentor to credit, please don't think that I'm that much older than him. Okay, it's just, we were getting in the industry at the same time, and I pulled my first credit report at the age of 12. It's a long story, family business, how that happened, but I've been around credit a long time, and I'm very grateful that he looks at me as a true resource for him and his company with regards to credit questions, and mostly today, problem solving and credit solutions.
Yeah.
On there.
Yeah, we're always brainstorming how to get somebody's score up when the scores are low. We always work through that. But guys, we're open up to questions to you guys, and otherwise we can wrap it up.
So if you have someone who has a collection account, what's the difference in the reaction in credit score to paying it off and getting a quote for the lender?
I love the question, and I'm just gonna combo his question with collection accounts and charge-offs. When is it good to pay off that account? What would be the impact on the score for that account being paid? So, A, you gotta turn to someone who knows how to read the credit reports, because in certain cases, you can't just tell someone, go pay that collection account or go pay that charge-off account, and it's gonna help your scores. That account could be 3 or 4 years old. Credit scores care most about your past 24 months. As things get older, they should impact your score less and less as time goes on. So we sometimes don't want to wake what we call a sleeping giant, and they say, oh, they told me to pay my collection and charge-off accounts, and they go out and spend money and pay these old accounts, and instead of it being a 3-year-old open account, it's now a brand new zero balance paid charge-off or paid collection. The goal is zero balance. So if somebody settles an account versus paying it in full, there's really no differentiation between there and the impact on the score, as long as whatever they choose to do with that creditor, they report a zero balance. No, charge-offs, people will think, oh, they charged it off, they're not even calling me to collect it anymore, they wrote it off their books, I don't know it, I don't have to pay it. Wrong. In certain cases, the lender is gonna definitively need that charge-off to be paid.
Not if it's an FHA loan, not be paid.
Right? And when the charge-off is paid, though, that could have a score increase because it typically reports as a maxed out account. So sometimes paying that charge-off could be beneficial. Paying that collection account may or may not be, but that's where the importance of the simulators come in, because it'll tell us, are they gonna be rewarded? Are they gonna be penalized? What should we do and how should we?
Because you would think paying an old collection account would be a positive, because you're making a positive event to your credit, you're getting rid of something that's negative. But you, like Vic said, you took a sleeping giant and awoken it, and now it's reporting 11/2021 paid collection account. Whereas they didn't report since 2016. So it has no impact on the credit. So that's where we run simulators, and if you're not sure, you can reach out to the credit company. He goes, my son also. So if you're in that situation, reach out to James or Vic and say, hey, if I have them pay this, will it help or hurt? And that's where we're experts when we look at somebody's credit, to understand, hey, it's worth it to pay this or not. And then we run the simulator to see what effect it might have. So, any other questions?
So I see on your first sheet, the basic rules of credit that apply the most. Number 3, And again, I don't know how this actually applies to the general public, but COVID and forbearance, right?
Mhm.
Let's say somebody doesn't pay their mortgage for the past 18 months. Is that something reported? And does that affect your immediate credit if, let's say, you want to sell your house, you need a mortgage to get a new property?
That's a mortgage guideline, so I'll answer that in a second. You wanna just talk about the.
Yeah, I'll
the
speak
credit?
about the credit impact side and then we'll speak about the mortgage guideline side. As far as credit is concerned, what we are seeing right now is any gap in payments has not resulted in a negative reporting to the credit bureaus by most of the lenders. As long as they come out of that forbearance or deferment properly, and when they do have a payment due, they make the payment due, understanding they can't still exercise a deferment or forbearance option. So that payment is now due December 1st or November 1st. I better be making that payment right now before that payment is due. Some creditors, I've seen errors in the reporting, but again, the best source for that is to speak directly with that lender. Why'd you report me late? I was in forbearance or deferment. Yes, you were, and I see them removing it in certain cases. And then I see other cases where the proper payment was not sent in and they have a valid delinquency to fight or counteract that. But you're correct, with COVID and the forbearance deferment, most of those lates are not being reported because they have given them that grace period.
Yeah, they were granted that grace period. With mortgage guidelines with it, so you have the FHA and then you have Fannie Mae and Freddie Mac. So with Fannie Mae and Freddie Mac, if they're selling the property that's in forbearance, it's acceptable for them to buy another property. However, if they're gonna retain that property, they have to have made their last 3 mortgage payments in order to buy a new house going Fannie Mae and Freddie Mac. Because they have to come out of forbearance and show that they can afford that mortgage payment again. With the FHA, it doesn't matter if they're selling the house or not, they have to make 3 payments. So in other words, if you're an FHA buyer, if you're an FHA buyer, you have a house to sell and you're in forbearance, you can't close on a new house if you're taking an FHA loan until you've made 3 payments on your last mortgage. And with the conventional guidelines, if you're selling a home in forbearance, you can buy right away as long as you're selling that home. However, if you're buying a second home and you're in forbearance on the property, you have to make 3 payments. So I'll say it's case by case. So if you have somebody that's in forbearance, you want to find out if they came out of forbearance and how long have they been out of forbearance. You know what I mean? And then share that with the lender. Just what you might have learned. We look at the credit report, we see it, but sometimes the credit report starts reporting again that they're making their payments. We don't know they were in forbearance because we only see the credit report reporting payments made. So we have to ask. Does that answer both your questions? A little bit?
I think so, yeah.
If we missed it, ask it again.
Yeah. I saw your name.
We found it.
This answered my question.
Gotcha. Very good.
Thank you.
Any other questions? Yes.
Back to the zero credit card balance, is it better to close out a credit card completely then if it has a
Good
zero
question.
balance?
Okay, good question. Closing accounts. Best rule of thumb, do not close any accounts ever. Okay, because we need that strength in numbers, but also we need to strengthen the length of time accounts are open. So we may suggest, or a lender may suggest that you need to close an account or 2. That's fine, because they will know you have other accounts, that are existing to keep the strength up of that profile. But I've had the people, holiday time is coming, come and open up a new card and we're gonna give you a free gift or 10% off, and they keep opening and closing, and you wind up not having any accounts that are open for more than 12 months or 24 months. So my rule of thumb is you can pay off an account, you can keep it a zero balance, but I would not close that account to know that you still have 4 to 5 active accounts that are open for multiple years, because the strongest scores are the ones that have accounts open for 5 and 10 plus years.
I close my wife's accounts all the time so that I can. I'm gonna go here first.
What about your credit limit? As far as I've read books about just reducing, like if I have a credit card that has a zero balance and let's say I have a $30,000 credit limit.
Right.
What are the benefits to keeping that higher credit or actually calling them and saying, reduce that line?
Can I answer that as a husband?
Sure.
I want that limit as low as possible. You'll.
Yeah, no, exactly. Now from the arbitrary, just credit. relevance. Two things with the credit limits, okay? One is we say to individuals, keep your balances at 50% or less of the credit limit. So this borrower has two $10,000 credit limit cards with $9,000 balances on it. And they're going, well, I could go home and take some savings and bring those balances below 50%, or let me call the credit card company up and say, hey, I'm at 10,000, could you take me to 20? Oh, Vic, you've been a great customer, you've been with us for 10 years, sure. So now I run back into Mark and I say, hey, Mark, my credit card balances are at 50% or less of the credit limits, let's stroke it up and my score drops. And you go, why? It's at 50% or less. Well, they know it's been at a maxed out level for so long, it's only a matter of time that 9,000 becomes 18,000. So again, raising your credit limits is not the secret to showing that balance in proportion to credit limits. And then also having those higher limits, it's a depend on if we view the credit, you might be fine taking 30 down to 15, just to ensure you're not going out and spending 25,000 on the credit card. But it depends on the overall balance in proportion to credit limits, because you might have that one $30,000 limit and say, I bring it down to 15. Well, because now you just reduced that available credit, now your overall proportion of balances to credit limits has just been reduced. So you may have been at 40% utilization, but taking that 15 away now brings you to 65, and it could drop your scores. So it's a lot of depth to the information and the rights of answers. But again, scores aren't a competition. We see spouses all the time fighting, hey, I have a 760 and I'm gonna get higher than you. And they wind up thinking they're doing something smart and they plummet their score. So I would say, once you get above that 740 level, you're kind of in the perfect realm of scores. Don't change anything. Don't do anything to try and get to that 800 score if you're in that level.
Yeah, you're already doing the right thing.
You already have it. There's no 4.0 with credit scores. It's just, being in that good
Yeah, 740.
realm. So be
So a
careful.
couple of things, because about 10 years ago, I had a card that had a limit of like 35,000. And back then I was doing just that. I was closing accounts. I'm like, this probably doesn't look good. It's a threat if someone steals my identity. So I closed it. Now, the cards that I have, there's about 3 of them that I have. I only use one. Food shopping, you get 5% reward back, so I use it. The balances though might only be like 10,000. Like, I feel like they're limiting me now. Even though I pay it off every month, I'm not building that credit where they're increasing. They never increase my limit. Not that I'm gonna charge that much, but I'm not seeing that credit build up.
Right, so she's had availability to say multiple $30,000 credit cards. She said, okay, you know what, I want to bring this down, reduce my exposure. So now I only have 3 $10,000 limit cards. I'm only using one card. So advice number 1 is bounce it around a little bit. Keep activity on multiple cards, because those other 2 cards are kind of going dormant if you haven't used them in 6 months, even though you just have that one card account. Then the other aspect is, well, I only have $30,000 in credit right now available revolving, and they're not granting me extra, I'm not going higher. $300 on $3,000, $3,000, it's a proportion of balances to credit limits. So you're not gonna be any less having, $300 on $30,000 available, versus having 3,000 on, 90,000 available.
Right, how do you get your score from an 800 to an 850?
You don't. You don't.
'Cause I
That's that dangerous realm. If you're an 800 and I heard it goes up to 850 and I'm just that competitive type person, I want the 850.
So in the mortgage world, I don't even think there's an 850. I think the highest score is an 840,
Is it?
maybe 848.
But I'm
And-
wondering what's keeping me from getting to that.
I've seen credit reports where somebody just got discharged from a bankruptcy and they have a higher credit score than somebody that never missed a payment. So,
Really?
it's like Vic said, it's just
Like
pay your
length of
bills on
time.
time, length of time, yeah.
Have that 20-year-old credit card or more, on there, and the positive activity, never late. Everyone suggests, now it's great, right? Put it on automatic payment, just take the minimum payment. You can always pay more, but at least there's never that mess up of the mail didn't make it through because of a flood or something didn't happen, or or I didn't get the email response, so again, setting it up on that automatic payment kind of protects what I feel is the most important thing, our credit and our credit scores.
So at least the minimum payments made.
One last question,
Go ahead.
sorry. So I always look at Experian,
Mhm.
because I get the reports annually, and I just review it. I never look at the other two. I think I attempted to do it one time, and it was a pain in the neck, because you have to go online and fill out the information.
All right.
Is there like an easy way to look at all three?
Yeah, call. All right.
Chloe? Okay.
And then you can also go to my annual freecreditreport.com or.
Yeah,
How is
the one true free site for your credit report is annualcreditreport.com, www.annualcreditreport.com. It's your credit report, it's not your score, but it's the true free site. You get a free report once a year and after every new credit inquiry. With COVID, I believe they were giving you a free report like every week just for people to stay in tune with their credit. It's almost a free self-credit monitoring service.
But
There's
it
credit
covers
monitoring
all
services
three?
that'll alert you to changes and different things, but you can go to Experian in January and get your Experian annual credit report. Then, 4 months later, go and get your TransUnion, 4 months later, go and get your Equifax, and you're kind of seeing all three bureaus and making sure everything on there is mine, everything is reporting properly, there's nothing reporting inaccurately that I feel I need to go after, but it's a good, way to do that.
Is,
But I'm sorry.
I think I get it. So if I go to transunion.com, is that free or do I pay for that?
TransUnion.com, you're gonna pay for.
So annual's free. TransUnion, if you go directly to the bureaus, you're gonna pay them for the report. So what Vic was suggesting is every 4 months, you go check out one of the 3 bureaus annually. So
Through annual.
no, annual is its own site.
Okay.
And then if you go directly to Equifax, TransUnion, or Experian, you can pay to get their report.
Right.
So then you can see
How do
what's
you
going.
keep them all in sync with one another? Because they don't report the same identical
Ah,
information.
Good
So
question is,
How do you get them in sync?
right, like how come they're not in sync? Well, the 3 bureaus, Experian, TransUnion, and Equifax are competitors, right? Your creditors are sending data to these 3 different entities at particular times they choose. So one bureau may get information quicker than another bureau from Citibank. There's no control on that. So again, when you pull a credit report, it is a single point in time access. Could a credit report change from 8 o'clock this morning and pull it again at 8 o'clock at night? Yes, because again, it depends on when the information gets updated on the profile. Is it likely? No. So don't become an addict, because I've had people checking their report like every 4 hours, to see what changes. It's not gonna change that quickly, but the 3 bureaus and the information, the bureaus are nothing more than a library. They don't create your report. They don't do anything other than store the information supplied to them. The authors of your report are your creditors reporting in your auto loans, mortgage loans, your credit trade lines. So again, typically, if you don't like something on that bookshelf that the bureau is providing, we don't go and yell at the librarian, I don't like this book. She's gonna say, well, go and talk to the author. And that's what you need to do, is talk to your author, Citibank, Chase, Capital One.
And then sometimes some creditors only report to one bureau.
I was just gonna ask that too.
Some do. You don't know
Why
unless
is
you
that?
follow it.
But
Just so-
that makes sense, why they're not.
They're
in sync.
not required to report to all 3, so they voluntarily choose if they report it to one or all 3. As a creditor, there's expenses and it's extra work to report to all 3. Most choose to report to all 3, but some don't. So you kind of have those variations.
Anything else, Scott? Yes.
I've heard like with a credit card, so say you have every month your balance is 3,000 and you pay it off every month. Does that hurt your credit?
When are you paying that balance? Are you letting the statement generate?
Yeah, so if I get
Okay.
an October statement, like October, and I pay it as soon as I get it.
What's your credit limit? See, there's all these different variants. If your credit limit is 3,000 and you're charging
So
3,000,
let's say it's like a $20,000 limit and you pay,
perfect, absolutely perfect.
oh, okay.
Because you're
right.
keeping activity. If you are someone that charges $3,000 but then goes dormant for 6 months and then comes back and charges $3,000, I might tell you to space that out a little bit, so each month you're having a little activity reported. Because again, the credit scores get scared when they don't see any activity, did they leave? Are they on an island? Did they just, move out of the country? Are they gone? What's happening? Show me a credit pulse. So you need that activity. And I might suggest if you want to split it on 2 cards, 15 and 15, just again, to have that multiple good things and reportings being said about it.
Similar question, so what if you're not paying full, but you're able to make the minimum, is that hurt?
Okay, great question also. So now I'm only making the minimum. Does that hurt? Yes. Over time, it's gonna show that I'm only making that minimum payment. Why? Because again, I, the credit score, do not know how much money you make or you have in the bank. So you kind of look strapped to me if you're charging $1,500 and I'm only making the $25 minimum payment. Now it went up to $1,800 and I'm only making the $26 minimum payment going through there. So you're not showing me some financial strength. So again, it's okay to bring a credit card up and pay it down for yourself. But again, I'd like to see you always making more than the minimum payment, because there is something new out there called trended credit data. It's in the background of the credit reports, but it's showing your last 24 months of payments. So if it's looking like these credit cards, the balances are high and all you're making is minimum payments, what's your opinion? I'm strapped.
They can't afford it.
I don't have a lot of liquid cash, I'm just getting by. Whereas the person that's sending more in bulk and getting that balance reduced is now showing strength. So they have that history, which is considered now for you. So,
Anything else, guys? I think we're good, right? Everybody's good? Thank you very, very much. If you have questions that you want to talk about offline, we'll be more than happy to. And thank you all for coming. And eat, please eat. A lot of food there.
Thanks for the.
Yeah.
Thank you.
Thank you, everyone.
Thank you.
Do you check cards?
Sure.
Thanks, Sue.
You're right, that first step, you're like, okay, they were. If you email me, mention Mark's name, complimentary answers to your questions.